and welcome to the Housing.com webinar on real estate prices, whether they will increase or they will go down due to the COVID-19 pandemic. I'm Jamur Ghosh, Editor-in-Chief, Housing.com News, and I'm joined by my expert set of panelists. Ramesh Nair is the CEO and Country Head of JLL India. Hi, Ramesh.
Hi, Jamur.
Reeza Sebastian Karimpanal is the head of the Reeza Sebastian Karimpanal is the president of the residential business for the Embassy Group. Hi, Reeza.
Hi, Jamur, and big hello to all the viewers.
Hi. Yeah. Nanda Kishore is the managing director of Ramky Estates and Farms Limited. So welcome once again, everybody.
Hello, everybody.
My first question is about the question itself. Hi. So I'm going to get down to the questions right away. This whole thing about, will real estate prices reduce or, are they going to increase? Is it such a simplistic yes or no question? I'd like to hear your thoughts on this.
Sure, Jamur, should I go?
Yes, please start.
Jamur, before I get into the pricing, it's very important to note that residential real estate is a very resilient sector. What we have seen happen in China over the last 3 months, the sector which bounced back the fastest and the first was the residential sector. We expect a few, it's not all good news for the residential sector. We need to understand and don't be in denial that things have rapidly changed in the last 5 to 6 weeks. We believe urbanization would slow down. India has 40 odd cities, which has a million plus population. In the next few years, this was expected to become 70 odd cities. That trend is going to slow down a little bit. There's going to be a lot more tech adoption in the sector for every aspect of real estate, whether from development, brokerage, there would be a lot more tech adoptions. That's something the industry needs to get used to. I believe a new sector will emerge, rental housing, as things become more affordable, as home loan rates and overall cost of funding goes down. It'll have a positive impact on globally. Rental housing is something which already exists. On the design side, I feel there would be lots of new things happening, whether it's private outdoor gardens, whether it's bigger study rooms, whether it's business centers within the same building, whether it's broadband. A bigger, better broadband. The other day I was talking to a developer and he was talking about how every project of his going forward is going to have a quarantine room. So new designs will emerge. I feel co-living and student housing would merge within the residential real estate sector. Don't know what share, but that'll kind of merge. What I also feel is in the next 2 years, it's very important for the residential real estate developers to look at how the commercial absorption is going to pan out in those respective cities, which has an automatic and a direct impact on the residential sector. Why were Bangalore and Pune residential real estate markets the last ones to slow down? Because these were the two markets which have done really well on the office front, with millions and millions of square feet of leasing happening and new jobs were being created, and that was automatically leading to demand in for residential. The last 1 year, the only market which has seen residential capital value increase has been Hyderabad. And that's the market which has seen gone into a 10 million square feet plus of office demand. So I think that's again important. I believe when the situation improves in the next few months, things kind of normalize when people are not too worried over their lives and jobs and salary cuts. I think there's a lot of pent-up demand which has already been there in the market over the last few years, which will come back in a big way. Prices will also kind of rationalize. One thing we need to remember when we track the 2008 versus today is today the market is a lot more end user focused. The market is much better valuations. It's a buyer's market. It's not a seller's market like in 2008. And there's a lot more tax benefits today available. Back then, everybody was doing a luxury large project. Today, all developers today understand what is relevant for the market and are doing that. Coming back to your question on price, it is pertinent to note that time correction of residential real estate has already happened in the last 4 5 years, when the market has been kind of it hasn't kind of gone up much. That's something we need to remember. Developers might resort to price rationalization to attract the fence sitters. There could be freebies being offered. All that will happen. However, this may not be uniform across markets. One big mistake analysts end up doing, or market forecasters end up doing, is Indian residential real estate is not one market. And we end up giving these forecasts on price increase, all that, and it's very, very different in different regions. So, however, this may not be, like I said, won't be uniform across all the markets, and will depend upon key factors such as demand and supply, quantum of ready-to-move-in apartments, quantum of under-construction projects. All that will have a bearing on the price. Rationalization will be combined with reduced home loan rates. We've seen the home loan rates today. This is probably the best home loan rates we have had in like 15 years. And with that kind of home loan rates, it's definitely expected to improve affordability in the residential market. So improved affordability, better price deals, better financial health of banks offering better deals, and greater demand from end users will definitely help in buyer sentiments. Thus, sales will happen. Some amount of price rationalization will happen. I don't think I can put a number to it. Over to you, Jumur.
Yeah. Reeza, I'd like to hear from you.
So, Jumur, I would just like to corroborate what Ramesh has said so far. And I would say that, while the overall market was seeing a downturn before this lockdown situation, Bangalore continues to be one of the healthier markets in all of this, right? In the last 2 quarters, that's Q3 and Q4 of 2019, we saw about close to 14,000 units being launched. But on the other side, we're seeing the absorption was almost 18,000 units. So this is also primarily owing to the fact that Bangalore, as Ramesh mentioned, continues to be a very end-user driven market, right? And has a very low inventory holding. And the drop in sales, therefore, is also is not as dramatic as how you would see in NCR, MMR regions. Certain micro markets in Bangalore has been extremely resilient. I would say Southeast, Southeast also, because exactly the reason why Ramesh mentioned sees very large influx of operational IT spaces. I would say close to about 30 million operational IT space in that area alone. So immediately there is an offtake on the residential component, social infrastructure, schools, hospitals. But North Bangalore seems to be taking away some of the charm of Southeast, owing to the fact that the airport is located in that area, and there's some great housing options in that location. Now, coming back to your question about whether prices will increase or not, I would say that the real estate industry was already at its lowest when the COVID-19 pandemic struck, right? And due to this whole situation of low demand, there are some good discounted rates and good inventories which are available. And I would say once this whole economic condition starts settling, give it another 3 to 5 months, the bargain will also reduce. And demand will start floating upwards for sure. So the rate will not be as low as they are now during the lockdown. I would also say that ready to move in inventory will start seeing greater preference among homeowners. And we are seeing today that the rates per square feet which are offered by residential real estate players are, there is not that much volatility, as being seen in stocks or in other financial instruments. We saw that Sensex lost almost 10,000 points in 1 month. So where is the safety in financial instruments today? So with the limited inventory being introduced in the market by developers, and that we are seeing in all our conversations with other developers as well, everyone's postponing their decision to launch new inventory. So I would say that the available ready to move in homes will see a very sharp rise in interest post the lockdown, because there is the touch and feel of the quality of the product. There is no risk, no GST. So even if this COVID pandemic kind of pushes completion deadlines by a couple of quarters a year, I would say the impending real estate boom is inevitable.
All right. Mr. Kishore, do you agree with your colleagues? Do you have a slightly different take? I'm curious to hear your thoughts.
I would first of all like to say that, see, if you see, real estate has been the oldest asset class. Okay. So over centuries, I think this is one asset class which has given consistent returns. It has been pretty much reliable. You find lesser volatility in real estate when compared to all other asset classes. So I still believe that, you know, definitely in the Indian context, people value real estate as much more stable and reliable in perspective of their investment. So that's one point. Second point, when it comes to the overall demand scenario, I'm pretty much sure there is a huge housing shortage across the country. I mean, there's no second thoughts whether there will be demand or not. Demand is there, demand will be there. The only thing is that there might be a slight lull in the market in terms of people trying to take a buying decision. So there might be a few months, maybe 3 to 4 months, where people will hold on to their decisions and only hoping that there will be some good deals coming their way, or there will be a slight price drop or something. In this context, what I would like to say, I mean, on an overall level, I believe that there won't be much of a price drop. What will be there, that you'll have a lot of schemes coming up, a lot of flexibilities coming up for people to pick and choose what suits their budget and what suits their requirement. That is something which is going to come up. And I also believe that, you know, this whole thing happened all of a sudden. So what it also means that most of the developers have a slight bit of leeway in terms of receivables. Most of them would be having at least a month or two of receivables on hand, which would be coming in the next couple of months. So which will keep them going. So what they will be planning for now is 3 months ahead. How do they feed the cash flows up and their construction after 3 months? For the next 2 to 3 months, I'm sure most of them have the cash flows in place through their receivables. So what would be the developers doing now would be, in the next 2 to 3 months, I'll be seeing most of them rolling out some schemes which will keep the sales clock ticking, and then, you know, cash flows will keep coming over the next 3 to 4 months, because usually it will take 2 to 3 months before the cash flows start coming in post a sale. So given this situation, I don't see a huge price drop. I will only see a lot of flexibility in the offerings that are going to come up. The other point, when it comes into the context of Hyderabad, as Ramesh rightly pointed out, Hyderabad market was doing very good in the last couple of years, the residential market also, as well as the commercial market. But primarily this was because Hyderabad was trying to play a catch-up game in the residential market in particular. If you see, we almost had a 5 to 6 year period where the real estate was in really not good shape. So Hyderabad was trying to play the catch-up. So it was the pent-up demand which was being picked up. So I would say Hyderabad still is not at par in terms of prices when compared to its peer cities. So Hyderabad prices, the residential prices in Hyderabad are still low. They have not yet caught up with the other cities. So what I foresee from a Hyderabad perspective is that I don't see a huge price drop or anything. I'm only seeing that there will be the time to conversion from what I would say the buying decision, the time to conversion from a site visit to a sale might be a bit elongated in this period. But I see more flexible schemes coming up rather than a huge price drop. It could be very, very marginal is what I feel.
Yeah, it's interesting. All of you have spoken about the schemes and, you know, how developers will continue to try and attract buyers. So we've received a lot of questions around this. The primary question seems to be like, how long will these offers be in the market? Will it be there for 3 months? Will it be there for 6 months? So can we help out our audience, you know, in terms of an assessment? How long will these offers last in the market?
Reeza, you want to give it a shot?
Yeah, so I would say definitely all developers or most developers, grade A developers, I don't see coming out. I mean, yeah, like Nanda Kishore rightly mentioned, I would say that, you know, there will be an extension of payment schedules. And that's something a lot of, you know, homeowners are coming to us and requesting us today. Can we get, because there is a stress on finances today. And so the people are coming to us and checking with us if it's possible to get an extension on payment schedules. From how long will this trend last? How long will the offers be on the table? I would say give it another 3 to 6 months. And that would be a fair assessment of how. So currently, we don't even know how long the lockdown situation is ongoing, right?
Yeah.
So we putting all perspectives in place, I would say 3 to 6 months. And after that, the market will start picking up. And the inquiries, closures, etc. will definitely start seeing a pickup.
Yeah. What about you, Ramesh? Do you agree with this assessment that 3 to 6 months is a fair time that we will see these offers in the market?
Yes, I'm quite sure there will be a lot of offers coming in the next 6 months. And for a person looking to buy to stay, I think this will be a good time to look at it from a contrarian point of view to invest in residential, because developers both the Nanda, Kishore and Reeza mentioned, developers are already operating in very thin margins and expecting prices to correct by double digits. A developer would go bankrupt doing that. So I think this is the time to wait for the next 3 to 6 months. Look at your deals and go and make an offer to a developer to buy the apartment at a good price.
Yeah. Mr. Nandkishore, do you think there's a chance these offers will get extended beyond 6 months, or are you also putting the window at 3 to 6 months?
I also, as I said earlier, it won't cross, in my view, beyond 3 to 4 months, because the developers will try to mop up sales during these 3-4 months so that, the further construction schedules can be maintained. That is number one. Number two, also very important here to understand is that, offers can be only in terms of little bit. See, it's like trying to fit the various needs of different customer segments. Each one has their own need, and it also changes from the stage of construction, and it will offer change from a project to project. One project which is in an advanced stage of construction might have a certain scheme. There will be another project which is in its early stages. So it is going to keep changing. So but I don't foresee this going beyond 6 months, because whatever the whole idea is that we are expecting within 3 to 6 months, the whole market will stabilize, and we will be coming to a situation where real estate will start functioning in a more normal way, albeit there will be some changes in terms of product design, in terms of customer preferences. But as from a demand perspective, I believe within 6 months we should be back to where we were, and it will keep sustaining. So I don't see the offers going beyond 4 to 6 months, and that's why I would also strongly advise. In fact, whoever is touch basing with me, I'm telling the same thing. I'm saying you don't expect things to go on for a lifetime. It's going to end within 3 to 6 months. That's it.
Yeah, we're also getting questions in terms of, and this seems to be from the investor community, that, right now, what is the safest bet? Should I be looking at ready to move properties? Or, if I really want to make a killing, in terms of pricing benefits, should I be going for under construction? So what advice do we have for buyers who have this question in their mind?
I think, Jumur, a buyer needs to look at firstly the home loan rates. SBI is giving very attractive rates. I believe other banks will be forced to come closer to the SBI rates, or there will be a lot of refinancing. A lot of existing home loan takers who will go to SBI. They will move from other HFCs and banks and move to SBI. So that's number one they need to look at. Second, one needs to look at is their own stability of income and the ability to pay EMIs. You need to evaluate if your job is stable, if you're in an industry or a company where you can expect salary cuts. All that is important before you go and overstretch yourself. That's very important. How is it affordable for you to pay the EMIs? Which is a fixed and a long-term obligation. You're looking at an obligation of 10, 15, 20 years. You need to evaluate that. Third is stage of construction. Today, that's very important, given that there are developers who are not very liquid. There are lots of good corporate developers, also lots of big developers. One needs to very, very closely look at the stage of construction. I personally wouldn't recommend looking at projects which are at a very early stage. Even if you're going to get capital appreciation, you should look for projects which are in either nearing completion or in the last 1 year of completion. And if you can find something which is already completed, all the more better. So stage of construction. And lastly, I would look at the reputation of the developer, a well-established developer who has a good track record, a good machinery for completion, who has financial closure, who's delivered projects over many years, who has timely delivery. There are no radar issues with the development. He delivers quality stuff even during downturns. These are some of the things one should look at before making a commitment, June.
Reeza, Nanda Kishore, as developers, do you agree with this perspective? Do you have a slightly different take on it when we pick, ready to move versus under construction? How do we evaluate this?
So I would say, Jamur, that I would just like to draw an analogy here for the listeners, and that's with the stock market. We say that there is a market cycle of emotions that this customer actually goes through when he's actually purchasing a stock. So all investors actually start with a level of optimism. We expect things to go our way. We tend to expect a return for the risk of investing, right? And at the top of the cycle, so when his expectations are met, I would say that investors experience a certain level of euphoria. But that's also a point when he's at the maximum financial risk. He's at the point of maximum financial risk, when we believe that the market cannot make any mistakes and returns are commonplace. Then you come to the stage 2, when the second phase of the cycle occurs, when the market stops meeting lofty expectations. We anxiously waiting and watching for the market to show any new signs of direction. And then we start to act defensively, and we start investing in safer asset classes like bonds. We move on to stage 3, right? And we say that the realities of a bear market come to the foray. And many people start withdrawing from the market. They're afraid of further losses. And there is a level of despondency which sets in. Ironically, it's at these times when an investor actually commonly fails to recognize that they're at a point of maximum financial opportunity. And this is exactly the stage where we are with the real estate industry today. So, from an investor standpoint, anything that is available today from a ready to move in construction standpoint, you walk into with a developer, you negotiate your terms with him. There could be minor corrections here and there, but I would say that ready to move in inventory would see definitely an uptick in the market. Anybody who's actually looking for a future home, or if he's a second home buyer, I would say wait for some more time. You could actually get great products in the market which are more futuristic in nature, more innovative, something that there are better solutions considering today's situation. To just throw a statistics on the table, I would say that from a share of when we're tracking how ready to move in inventory is moving versus new launches, we are seeing that the share of ready to move in is gradually increasing in your overall sales. So that's almost 4% increase in overall ready to move in sales versus a 32% year-on-year decline on under construction units.
Nanda Kishore, do you have
in my view, I think more than whether the stage of construction, I think what is going to also happen is customers are going to look at what is going to best suit their purposes. So I am foreseeing a lot more demand for integrated townships, walk to work kind of housing. I'm sure people's preference, they wouldn't mind waiting for a year or so or 2 years if they can get the housing which is going to meet all eventualities, all kind of circumstances. I'll tell you what has happened in this past 1 month lockdown and all that. People who have been living in standalone apartments, or where there is a community is missing, or where they don't have the facility management systems and all those, they have really struggled because they have to fend for every small thing that they need. Whereas in gated communities, large integrated townships where people have been living, or where they have these walk to work or whatever facilities, their life, they have been less impacted because of this lockdown, because they had everything available at their doorstep. So this is something which is going to weigh heavily on people's mind when they are going to take a buying decision now. So I am foreseeing a lot more buying preference shifting, rather than on the stage of construction, to people looking at what fits them best and what is going to be more futuristic in terms of their requirements. So that is what I'm foreseeing. And second thing, once they are zeroing in on they see that something is matching their requirement, then whatever Ramesh said will come into play in terms of developers' reputation, their past track record, the stage of construction, the financial and other flexibilities that are being offered. That will all come into picture. But I see a strong shift towards integrated township, walk to work, and those kind of things.
Yes. Jumur, can I also touch upon the stocks and bonds thing which Reeza spoke about?
Yeah, please go ahead.
See, today the mutual fund industry today manages around 25 lakh crores of rupees, and a lot of this has moved out, should have come to the real estate sector. Today, a lot of stock market investors are kind of realizing that they should have rather invested in the real estate market, seeing all the volatility in the stock markets and mutual funds in the country. When you're investing in real estate, it's very important that you don't you need to see the benefits of real estate versus mutual funds. Real estate is a very tangible asset, which has lots of psychological comfort, security, satisfaction. All that is there. It's an asset one needs to, if you need to kind of settle down in life. So real estate investment, residential investments is important for that. Real estate, even over the years, I'll talk a little later on the kind of capital appreciation real estate has seen even during these tough times in the last 10 years. We've still seen close to 41% has been the country average of capital appreciation over a 10-year period. I know the last 4 years has not been great, but if you look at it like a 10-year period, it's still 41%. Real estate investments, price increases, rental returns, a lot more predictable than mutual funds. You don't have Black Mondays or Black Fridays in real estate. You don't see your value of your real estate go down 20 or 30% in one day. It happens in the stock markets, in the mutual funds space. So that's something investors need to keep in mind. In these kind of times, you can't afford to lose the value of your asset by 20% or 30% in a day or in an hour sometimes. So one needs to keep that in mind. Look at the volatility of the real estate sector. Very, very limited. Even if things start slowing down, it takes like a few years for it to slow down, and it gives you good opportunity kind of exit. Today, thanks to the government, there are good tax deductions, easy to leverage. EMIs are very easily available for real estate. It's a passive income stream plus reasonable capital appreciation. You can't see the kind of capital appreciation you saw between 2004 and 2008. When we saw real estate, residential real estates at that time saw 225% capital appreciation. The problem is people are used to those kind of numbers, and then they start putting in real estate thinking that's the kind of numbers. You need to look at it from a 10-year point of view. You can't look at put money today, take money out 3 months later, and real estate is a long-term investment. You have more control over your portfolio if you're investing in residential real estate. It's not an overly diversified kind of an asset class, which has its pros and cons, and very kind of reasonably insulated from market risks. Today, you read a newspaper article that day, your stock price will go down, the entire stock market can go down. Real estate doesn't behave like that. Today, there are 3 bad news in economic times on Mint on Business Standard. You're not going to see real estate prices coming crashing down. So my request to the viewers is please look at real estate as a long-term bet. Don't look at it from a short-term bet. And all these advertisements we've seen for mutual funds over the years, and just look at what happened last week, where 6 mutual funds just went bust, and there are lakhs of investors who are stuck with their money. Real estate also has its bad apples. There are bad developers. There are good developers. There are one needs to study them carefully before investing. And I truly believe a lot of money, unnecessary money, went from real estate into mutual funds in the last 3-4 years, and that's caused such a bubble in the mutual fund industry, which is leading to all these kind of things we've been seeing over the last few months. This extreme high volatility which has been happening in the sector.
Yeah. So I'm going to do a bit more of deep diving, because even the questions that we have been receiving, whether the prices will increase, decrease, there have been segment specific questions as well. Of course, the major bulk of the questions have been about the affordable to mid segment, that, what will be the price implications on this segment, due to COVID-19. So can we give our, a viewer some sort of a estimate, that what kind of price implications could there possibly be for this segment?
See, developers have kind of continued to keep their focus on affordable and mid-priced segments. In Mumbai, I would say that's like a crore, while in other cities, maybe 75 lakhs. While the share of these segments remained significant, at even more than 50% in 2019, a dominant of the launches were directed towards affordable and mid segments in the first quarter of 2020. Whatever happens post COVID, developers are likely will resort to price rationalization. I believe there will also be size reduction. And with home loan rates coming down, and the government would announce more schemes, not what they've done already. I think on the affordability scale, Indian residential real estate will only become better and more affordable. This is definitely going to have a positive bearing on home buyers, more so in the affordable and mid-priced categories. The existing tax incentives, and that's a good thing the Modi government has done, both direct and indirect, available for home buyers in these segments, combined with the tax ops for developers. Sections like ATIB getting extended. I think overall for affordable and mid-market housing, it's going to be a good time. On the other side, I also feel that luxury housing developers will need to kind of change their business plans and look at how they can kind of change their overall market strategy.
Yeah, Jamur, just to add
Reeza,
on.
what's your take on this?
Yeah, so Jamur, just to add on to both the affordable and the luxury points that Ramesh made, I would say that nearly 40% of the new launches across top 7 cities in this last few years have come in the affordable segment, right? That's anything less than 40 lakh. And of course, there is a very strong government push that has happened on the Housing for All mission, several SOPs to the home buyers, the developers as well. The Pradhan Mantri Awas Yojana, remarkable success, 1.1 crore houses across the country. Also, this latest investment fund, which is the Swami Fund, that's also formed to complete construction of brownfield and RERA registered residential developments. Now, these are all anything that needs last mile funding, etc., would see support from the government. Now, from the developer standpoint, I would say that in the affordable category, scale is very important, right? And the ability to reuse construction methodologies. So depending on how much offtake is there is when he will go back into the market to reintroduce products. So for any developer working in this space, scale is very important. So any day of delivery, any day of delay that he experiences, be it on approval side or on sales offtake, is going to have an impact on pricing. Right? That's one part of it. The other part of it is that for a buyer of an affordable home, I would say that access to public infrastructure is a very important purchase consideration, especially in times like this when non-discretionary expenses are on the rise. And he has so far looked at rental homes within the city. Now, if you have to coax him to buy, with all this uncertainty around this job scenario, especially for blue collar jobs, I would say that homes below 15 lakhs may face a slight level of stress, but there is a definite demand for it. There is a definite audience for it. And the larger portion of India's population is geared towards buying an affordable home. And that's where a definite need is there. From the luxury standpoint, I would say that yes, would see a slowdown in sales in the immediate term. But how many builders today are doing high-end inventory, right? Luxury inventory, extremely limited inventory coming into play. Embassy has been a very strong player in luxury properties, specifically in Bangalore. And we know that our buyer today is an extremely well-traveled, exposed, knowledgeable person. And his awareness and expectations are fairly set. Way back in 2013 to 14, when we went on this path of building luxury homes, we created self-sustained developments that emulates a quality of life that he aspires to have. Even well-researched projects like putting in home offices, servant quarters, staff quarters, common amenities, which are very essential in today's scenario as well. From how will the impact be on luxury and going forward? I would say we are seeing a strong response from NRIs specifically, who are today settled in US, UK, even from Singapore as well, who are actually thinking of investing back in their own nation. Today, India, I think, has handled the COVID issue much better than most countries. And they have set a good example for the rest of the world. And today, I think Indians living in far-flung countries are realizing that their social security is far better in their own country than in where they are living currently. Also, the low return on investment on bank deposits is another opportunity for NRI investor to use their deposits to buy a home in India at a lower interest rate, while getting an added advantage due to the depreciation of the value of the rupee.
What about you, Nanda Kishore? I'm curious to know what do you think is going to happen in the affordable to mid as well as the luxury segment?
See, affordable housing segment, no doubt about that. There is a lot of demand and there's a lot of incentives being offered by the government, and I think it will continue to do good. But I don't foresee a drop in prices in affordable segment because there the margins are thin, very, very thin. I mean, it works on volumes. It doesn't work on margins. It works on volumes. It's like any other manufacturing. So I don't see a drop in prices in the affordable housing in its purest sense. When I'm talking of affordable, I'm talking what comes below the 45 lakh budgetary limit. So I don't foresee any price drop there. But what I foresee is that there will be a lot more demand coming up for affordable housing, maybe in the next 1.5 to 2 years, where if what people are talking about comes true, like a lot of manufacturing bases shifting to India, then I think the number of blue collar workers are going to increase, and there will be a lot more demand than what we are currently seeing. As it is, there is a huge demand. And I'm seeing there will be explosive demand for housing. If that happens true, I'm saying 1.5 year is because, it usually takes to set up anything, it will take at least a year and a half in India. So if that comes true, I think we'll see an explosive demand. But even otherwise, I see a lot more demand, good demand for affordable housing, but I don't see a price drop per se. And when it comes to luxury housing, let me say here that luxury housing actually is, when I'm talking with the top end luxury housing, they're actually not price sensitive. They are actually not price sensitive. They would look at the product more importantly. They would look at post-COVID, what kind of response system the developer has, what kind of facilities and amenities are they providing, how am I protected from any such eventualities. I think that will be the primary concern. And when I'm talking about the extreme high-end kind of luxury properties, so there I don't think they are price sensitive. It will be more like waiting for the right product and buying is what I foresee. So overall, what I would like to tell here is something very clearly is, even in the mid segment, see, most of the developers today are operating on very thin margins. And as it is with the way things are happening, I think I see a spike in the input cost, particularly the labor cost, which forms part of at least 40 to 50% of the total cost today, even with all the technologies that we have. So with the spike and all that, I think the margins are going to shrink even more. So I don't foresee much of a leeway left for the developer to reduce the prices. And I'm sure despite whatever we may say, the funding for real estate still is very difficult. People have to rely on customer advances and to fund their construction. So as it is, they are selling at pretty low prices and low margins. I don't foresee much of a leeway for people to cut down prices. Gone are the days when people had 40-50% kind of margins. So I don't foresee much of a price drop. I would see more of schemes and flexibilities being offered to the buyers to suit their individual requirements.
So anyway, I think we've got time for just one last question. So my last question, I am hoping that, we can give some silver lining to ourselves and to our audience. So what I would like to know is, by when do you think we can at least start seeing some kind of recovery from the COVID-19 situation, and just overall, when can demand, sort of come back to what it was, pre COVID-19. So I'd like to hear all of your thoughts on this.
I was reading somewhere that Joseph Stiglitz's quote, which said that we know we don't know enough. So it's tough to predict. There's so many different variables which are not under control, Jumur, that it'd be very tough to give a kind of a date prediction on that. But overall, when you look at the curve, the residential curve was nearly at the bottom, and that's what you need to look at. You can't price it exactly at the bottom like in stock markets. While the stock markets were at its peak, the residential real estate was at its bottom. So it's at the bottom, 10% here and there, and that's when you need to take a call on your residential buy. We also need to realize that the economy was not doing very well even before COVID. At 4.5%, it was probably the worst quarter we've seen in decades. So we already had our own challenges on the GDP front. Residential demand was beginning to pick up in the early part of 2019. 2019 saw nearly 6% more sales than 2018, but again, this will kind of slow things down. The first quarter was not good for obvious reasons. It's a drop of 30% in sales compared to 1Q 2019 versus 1Q 2020. Demand in Q2 would be negligible. There won't be any sales happening because we all are staying at home. So we shouldn't be comparing 2019 numbers to 2020, at least for the second quarter. But important to remember that the market is in a much more advantageous position than in 2008, 8-9. All the factors I mentioned before, and increased affordability. With increased affordability, and primarily one needs to look at what the duration and intensity of this outbreak is going to be, and if things improve fast, the markets will also kind of improve fast. So mainly given the current situation, sales mainly in affordable and mid-market segment are expected to see some kind of green shoots of recovery towards end of this year. And towards the festive season. Like I mentioned earlier, there's a lot of pent-up demand. Last 4-5 years, a lot of people have been kind of delaying their decisions. And if developers come out with good schemes, the government comes out with good stimulus package for the industry, that'll lead to things looking northwards.
Reeza, you've been a bit optimistic, even in our chats earlier. What's your take on this?
I would say, Jamur, that this is a crisis. This whole COVID crisis has made everyone realize the value of owning a home. There's no crisis that has made us realize this better. I would say that for potential home buyers who have job security, cash flows, this is an excellent buying opportunity right now. You just need to invest close to about 20%, utilize your bank funding to grow your investment. Your home finance costs are fairly low at this point. Unlike in stocks and bonds, etc., where you have zero control on investment, like Ramesh said. But real estate presents itself various opportunities, right? You can rent it, you can refinance it, you can sell it, you can move it to other real estate investments. And I would say that it is a very favorable, trustworthy, and economical investment at this point in time. Yes, will we see a blip in the market? Yes, for the next 3 to 5 months, there could be a downturn, but it just shows how the market's going to pick up thereafter also. Because like the rest of the panelists said, there is a latent demand and pent-up demand in the market, which will definitely see us seeing some uptick in our numbers and in our growth trajectory. It's also understandable why our viewers are fearful at these uncertain times, but it's important that it's during these moments that the best opportunities arise. So as long as you do your due diligence, you pick credible companies to invest in during this time of crisis, I'm sure you are setting up your portfolio to for some very sizable gains down the road. And I would like to leave the homeowners with the immortal words of Mr. Warren Buffett, who said that be fearful when others are greedy and greedy when others are fearful.
Okay. Mr. Kishore, so I think the final word will rest with you. So let's hear your thoughts on this.
Yeah, I strongly feel India has got a lot of pent-up demand for residential, and there is no doubt whether there will be good demand or not, whether the prices will hold or not. Definitely, all that will be true and it will hold. What also, if whatever theories are going around now regarding this work from home, we'll see a significant shift in work from home, and a lot of people will. I think it is quite a possibility. I don't know how much percentage. It may not be like 60-70% of people working from home. Even if it's, I think today we might be at 10-90. It might move from 10-90 to 30-70 or 25-75, whatever ratio. Even if 25% people work from home. What also it opens up another a huge opportunities here is that when work from home happens, it will be the cities which are having the lower cost of living, better quality of living, which will have a significant advantage, because once you're working from home, it doesn't matter where you're working from. So in that context, I think I'm slightly selfish here. Being from Hyderabad has stood number one in quality of living. So I see a huge advantage for Hyderabad in that sense, because a lot more people, wherever they would prefer to work from Hyderabad. Cost of living is low, quality of living is high. Real estate is pretty cheap here in Hyderabad. So, and it might also open up opportunities in smaller towns. I mean, they might as well work wherever there is infrastructure available. But I think it will take some time. It won't happen. Work from home cannot just happen overnight. It will take maybe a year to couple of years for everything to settle down, to really reach that stage where people have that infrastructure availability. So while this is on one side, so what I very strongly feel here is that, see, as I said at the very beginning, real estate is the oldest asset class, one asset class which has been giving consistent returns over years. It is stable, it is real, it is physical, it is tangible. I don't think there's anything more reassuring than that. And as rightly pointed out by my fellow panelists, do your due diligence, look at the right developer, look at the right product, see what you see. Ultimately, it is about matching your needs. So whether you are an investor, whether you are an end user, see that it matches your needs, and also look at slightly ahead of time. Look at into the future. Don't look at your current needs, today's need. Look at your needs 2 years down the line, 3 years down the line, and make your buying decision. And I can tell you for sure, compared to any other asset class, real estate is the safest and the best bet. And as we have said earlier, this is the time to buy. Make an informed decision, and I'm sure we'll see good times to come.
Well, that's a great note to end this conversation on. Thank you so much for tuning in. We will be seeing you soon. Till then, stay safe and stay healthy.